Anthony Cragg, Portfolio Manager at Wells Fargo Asset Management. He joins us on the show from London. Anthony, hi, morning. Do you see India better placed in terms of macros versus Asian and other emerging market pairs? And do you see better fund flows coming into India?
We do. We believe in that India is now enjoying, hopefully, the dawning of a kind of growth transformation. We do think that the election of Mr. Modi is very significant. He has had a very strong track record, as you know, in Gujarat, and hopefully he can now achieve that on the national scale. So we do think a lot of the optimism is warranted, and that the reform agenda that the government is putting in place or trying to put in place will expand growth and will unlock some of the potential in India that was previously hampered. Having said that, I think in terms of valuation, it's a market that is very well owned. Foreigners are very involved in there. Valuations have expanded. So to a certain extent, the market has paid forward some of that goodwill. In other words, they've already built in to prices some of that optimism. But we do think there's significant potential in oil and gas, in the power sector, in some of the state-owned enterprises whose potential will be unlocked.
So, Anthony, what is your view on the Chinese economic growth, and what do you think, China will do to global commodities now?
China is still obviously, despite the slowdown, is still growing faster than India. Yesterday's print was about 7.5% on GDP. So I think going forward we're going to see lower growth in China, but I would say probably healthier growth, more sustainable growth, avoiding some of the excesses of the very, very high growth years. I think stabilizing of the Chinese economy is obviously good for resources around the world, and I think we're beginning to see some recovery in some of the materials, metals and mining, resource companies, because let's face it, 7.5% is still a big number. It's definitely down from the heady days of 11, 12, 13%, but China is still a massive economy, now the second biggest economy in the world, growing at a very healthy tick. So I think the outlook is not as bad for materials, metals and mining as people have thought recently.
Right, Anthony, there were high expectations from the budget this time around, and we've seen equities cooling off since then. Would you take this as a buying opportunity when it comes to India?
I think we would, selectively. The budget was slightly underwhelming, I would say, and people did use it for a bit of profit-taking. I think the transformation in India realistically will take many months and probably many years. So it is wrong to think of Mr. Modi coming in and waving a magic wand. But we think any significant pullback would be a buying opportunity in some of those names which stand to benefit from the reform agenda and from the new government.
So, Anthony, at the current juncture, what is your sectoral preference? Where are you bullish? What are you avoiding? And what are your key underweight and overweight positions?
Well, we think there's a lot to be done with some of the perhaps sleeping giants, if I could call them that, the ONGCs, Coal India, for example, one of the major coal producers in the world, but has typically underdelivered in terms of performance and production. So I think there's a lot that the new government can do to revive some of these sleeping giants in the Indian economy. Meanwhile, there are also some just great names in India, some great companies, whether it's TCS or Maruti Suzuki. There are things that we will continue to like, almost irrespective of what the government is doing. But I would say a lot of it at the moment is policy-driven and government-driven.
The budget has also hiked the FDI in defense as well as insurance, Anthony. What is the kind of fund flows that you see via FDI coming into India, and also how do you see the FII flows shaping into when it comes to India?
It's hard to quantify, but I mean, clearly foreign investors have wanted, foreign companies have wanted to involve themselves in FDI and invest directly in India for many years. We've had a number of kind of false starts. For example, in the retail sector, for a while it was thought that the multinational retailers would be able to invest directly, and then the government pulled back from that. This time I think it's for real, and there's definitely a lot of appetite. It's very hard to quantify the number at this stage, but I think going forward we're going to see a lot of foreign direct participation in Indian business, and I think that's healthy both for the foreign investors and for the local economy.